Hi everyone. Before I start this video, make sure that you're a part of my Discord server by joining the link in the description box below. And in this video, we'll be going over 2024 May-June Paper 3-1 and Paper 3-3 question number 2. This is structured paper 3, which consists of 3 questions. Each of them will be of 25 marks, and the total time limit for this paper is 1 hour and 30 minutes. So ideally, you should be spending about 30 minutes in order to solve each question. And in this video as well, we'll be attempting to solve this question number 2 under 30 minutes. So without any further delay, let's get started. The directors of MPLC have prepared the financial statements for the year ended 31st December 2023. The following information from the financial statements is available. We have been given the statement of financial position at 31st December 2023 with non-current assets, current assets, equity and reserves, non-current liabilities and current liabilities. Okay. We have been given the statement of changes in equity for the year ended 31st December 2023 only for the retained earnings. Okay, we started with the opening balance, added profit for the year, subtracted the dividend paid and got the closing retained earnings value. Okay. Then further information is also available. All sales and purchases are on credit. Alright, goods are sold at a markup of 45%. So markup of 45% just means that the selling price is equal to cost times 1 plus markup, which in this case is 45%. Then the inventory value at 1st January 2023 was 79,000. We have been given the non-current asset turnover to be 1.25 times. Okay, so the formula for the non-current asset turnover is the net revenue divided by the net book value of non-current asset. So we will use the information for, so 1.25 will be equal to the net sales divided by the net book value of the non-current assets. And we have been given the statement of financial position from which we can extract the value for our non-current asset, which is 696,000. Okay. So 1.25 will be equal to sales divided by 696,000. And this will give us the value of sales to be 1.25 times 696,000, which results in the value of 870,000. Okay. From this, we can use the second information of markup in order to get the cost, or in this case, the cost of sales. So the selling price or the sales value is 870,000. We do not know the cost of sales times 1 plus markup of 45%. Okay. So the cost of sales will just be 870,000 divided by 1 plus 45%. This will result in the value of 600,000. Alright, then from the cost of sales, we can calculate the purchases value because we have our opening inventory of 79,000 and we have our closing inventory right here of 88,000. Okay, so the formula for cost of sales is opening inventory plus purchases minus closing inventory. This should be equal to 600,000. The opening inventory in this case is given to be 79,000. We're trying to calculate the purchases and the closing inventory was 88,000. Now let's solve this equation. The purchases will be equal to 600,000 minus 79,000 plus 88,000. This will result in the value of 609,000. Okay. So that is all that we could find from information 1, 2, 3 and 4. For information 5, a final dividend of 0.14 per share for 2023 was proposed at the year end. Dividends paid during the year comprised a final dividend of 60,000 for 2022 and an interim dividend of 40,000 for 2023. So the total dividend paid during the year is 60,000 plus 40,000, which is 100,000. Let's take a look above at our retained earnings. This is the exact dividend that we've subtracted here. So that is correct as well. Now, the company's ordinary shares are currently priced at 2.56 each. So this is the market price per share. Alright, let's take a look at our first part of this question. We need to explain the stewardship role of the directors in a public limited company. Okay, so in a public limited company, the ownership and the control are separated. The public limited company is owned by the shareholders, but the control is given to the directors, which means that the directors are responsible to the shareholders in order to maintain and run the public limited company. Let's write it down. In a public limited company, the ownership and control are separated. So the directors are responsible to the shareholders. This just means that the directors should act in the best interest of the shareholders, so they must exercise their integrity and avoid any conflict of interest. Let's write it down. The directors should act in the best interest of the shareholders, so they must exercise their professionalism and integrity and avoid any conflict of interests. That is all for the first part. Let's move towards the next one. We now need to calculate the working capital cycle in days. We need to round up the components to the nearest d. Okay, let's write down the formula for working capital cycle. So this is just going to be the trade receivables turnover plus the inventory turnover minus the trade payables turnover. Okay. Now we need to calculate each of these components. Let's start with the trade receivables turnover. The formula is quite simple. It is just going to be trade receivables divided by the credit sales multiplied by 365, since we are calculating it in days. So for the value of trade receivables, we can just refer to the statement of financial position. Right here, it's 142,000. Then we have been told that all sales and purchases are in credit. So we can just write down the value of our sales, 870,000. Let's write it down. So that is 142,000 for the trade receivables. Then we divide it by 870,000, which is the credit sales. We multiply it by 365. This results in the value of 59.57, and we just need to round it off because we have been told that we need to round up the components to the nearest days. That is just going to be 60 days. Now we need to calculate the inventory turnover. Inventory turnover is quite simple. So the formula is just going to be the average inventory divided by the cost of sales times 365. So the first thing we need to do is calculate the average inventory. Average inventory is just going to be opening inventory plus closing inventory divided by 2. So we have our opening inventory to be 79,000. Then we have our closing inventory to be 88,000. Then we just divide it by 2. So this gives the average inventory to have the value of 83,500. Then we've already calculated the cost of sales to be 600,000. Let's write it down. So for average inventory, we've calculated the value to be 83,500. We've already calculated the cost of sales to be 600,000 times 365. This results in the value of 50.796. So we can just round it off as 51 days. Now we need to calculate the trade payables turnover. The formula is quite simple. It is just going to be trade payables divided by the credit purchases. Let's take a look above. For trade payables, we can use this value of 125,000, and we know that purchases are made on credit. So we can just write down the total purchases of 609,000. Let's write it down. We have the trade payables to be 125,000. We have the credit purchases to be 609,000 times 365. This results in the value of 74.92, which we can round it off as 75 days. Okay, now let's just input these values. So the trade receivables turnover is 60, inventory turnover is 51, and trade payables turnover is 75. This gives us the working capital cycle to have the value of 36 days. That is all for the second part. Let's move towards the next one. We need to calculate to 2 decimal places the following ratios. The first one is price earnings ratio, and the formula is pretty simple: market price per share divided by the earnings per share. Okay. Let's take a look above. We have been given the market price per share to be 2.56. Now for the earnings per share, the formula is pretty simple. It's just going to be profit for the year divided by the number of ordinary shares. We have been given the profit for the year right here, which has a value of 140,000. Now we first need to calculate the number of ordinary shares. In this case, we have the nominal rate of 1 and the total value of 500,000. So the number of ordinary shares is just going to be the value, because the formula is value divided by the nominal rate, which in this case will be 500,000 divided by 1, which will result in 500,000. So 140,000 divided by 500,000. This will result in the earnings per share to be 0.28. Let's write it down. So we have been given the market price per share to be 2.56. We just calculated the earnings per share to be 0.28. This results in the price earnings ratio to have the value of 9.14. That is all for the first one. Let's move to the second one. We have dividend yield. The formula for dividend yield is quite simple. It is just going to be dividend per share divided by the market price per share times 100. And remember that the dividend per share will include both the dividend paid per share and the dividend proposed per share. Let's take a look above. We have been told that a final dividend of 0.14 per share was proposed. So this is the dividend proposed per share, and currently we're only talking about the dividend per share for the year 2023. So we will not be including this dividend paid for 2022. We will only be including this 40,000 that was paid for 2023 as an interim dividend. So the dividend paid will be 40,000. This is the total dividend paid, but we require the dividend paid per share. So we just need to divide it by the number of shares, which is 500,000. This results in the dividend paid per share to have the value of 0.08. Now we also need to add the dividend proposed for the year 2023, that is 0.14, and this will result in the value of dividend per share to be 0.22. Let's write it down. So we have calculated the dividend per share of 0.22, and we have been given the market price per share to be 2.56 times 100. This will result in our dividend yield to have the value of 8.59%. That is all for the second one. Let's move towards the next one. We have interest cover. So the formula for interest cover is just going to be profit from operations divided by the finance cost or the interest charges. So we can just write this down as interest payable. Okay. Firstly, we need to calculate profit from operations. And we have been given the profit for the year right here, 140,000. So remember the format for the statement of profit or loss. We start with profit from operations, subtract the finance cost, and get our profit for the year, right? We're trying to calculate profit from operations. So finance cost is just going to be the interest payable, which is the interest charge, and that will be on our non-current liability, which in this case is a 6% debenture. So the interest on this debenture is just going to be the debenture amount of 180,000 times the debenture interest rate of 6%, which will result in the value of 10,800. So that is our interest payable as well as the finance cost. Then profit for the year is given to be 140,000. Now profit from operations is just going to be 140,000 plus 10,800, which results in 150,800. Let's substitute these values. So profit from operations is 150,800, whereas the interest payable, which is equal to the finance cost, is 10,800. This results in the interest cover to be 13.96 times. That is all for the third one. Let's move towards the next part. We have been given some additional information. XPLC, which is a competitor, has a working capital cycle which is shorter than that of MPLC. We need to explain why XPLC has performed better than MPLC in managing the working capital cycle. This is a 5 mark, so we need to list down 5 reasons why XPLC has performed better than MPLC in managing the working capital cycle. Okay, first of all, let's take a look at our formula for the working capital cycle. It is trade receivables turnover plus inventory turnover minus trade payables turnover. So the working capital cycle will be shorter if the trade receivables turnover is shorter for XPLC as compared to MPLC. So we can just say that XPLC's credit customers may take a shorter time in order to settle their trade debts. Let's write it down. XPLC's credit customers may take a shorter time to settle their trade debts. Now we can comment on the next component as well, which is inventory turnover. So in order to have a shorter working capital cycle, they will also require a shorter inventory turnover, which means that XPLC may take a shorter time to sell its goods. Let's write it down. XPLC may take a shorter time to sell its goods. Okay, then for the third one, we have trade payables turnover, which we subtract. So in order to get a lower working capital cycle, the trade payables turnover should be higher. So we can just say that XPLC may take a longer time to pay its credit suppliers. Let's write it down. XPLC may take a longer time to pay its credit suppliers. Another thing we can comment on is that XPLC might be more efficient than MPLC in converting the net working capital, which is the current assets minus current liabilities, into cash, because that way they will have a better working capital cycle as compared to MPLC. So XPLC may be more efficient than MPLC in converting net working capital into cash. The next thing we can see in order to explain why XPLC has performed better is that they might be in different industries. So XPLC and MPLC might be in different industries. That could also explain the difference in their working capital cycle. Okay, that is all for the fourth part as well as this entire question. If you found this video useful, make sure that you like the video and leave a comment below, and make sure you're subscribed to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.